I've said it before and I'll say it again. The only way that you can practically lose money in index fund investing is if you panic sell. And that is why one of the biggest components of investing in broad-based index funds is psychological. If you can gain control of your actions by being intentional in the things that you do, then you're going to make it just fine. You're going to become a master of your cash flow, and you're not going to be able to panic sell. And learning to be greedy when others are fearful is one of the most important steps that you can take to growing your net worth. And today, what I want to share with you on this episode of Casual Sundays is what it would look like with my portfolio, my individual portfolio, all of my investments, what it would have looked like if I would have panic sold during a recent, kind of market downturn, during a recent bear market. I'm going to pretty much follow you through February through June of 2020, because in that time, as you all know, probably what was going on, the U.S. stock market took a pretty big dip, pretty significant. And that means me, as investing in broad-based index funds, mostly in the U.S. stock market, my portfolio overall also took a pretty big dip on the downward trend. But if I didn't stick it out during that time, I would be way worse off than I am right now. But luckily, I know not to panic sell. And that is hopefully what I want to talk about today in this episode of Casual Sundays, is how panic selling is one of the worst things that you can do for building your net worth in the long run. You need to know that market downturns are coming. We just had one, and the market is almost back to normal as of when I'm talking about it right now. Now, who knows when the next one is going to come, but I can tell you this. Another downturn will come. The stock market will go down, 10, 20, 30%. It will happen again. I don't know when. No one really does, but it will happen, and you need to be prepared for that. And you need to be psychologically prepared for that, because panic selling, as I mentioned before, is something that you definitely want to avoid. I first want to talk about, just some 3 little principles, like basic general rules when it comes to economic downturns. So when we talk about a stock market correction, generally speaking, what that means is the stock market goes down 10% from its peak. So recently in February 2020, we had a stock market peak. It was the highest that it's ever been. And then once it hit down below 10%, that is what's known as a market correction. And then once you go down past to negative 20% from its peak, that is usually known as a bear market. And furthermore, after that, when we're talking about a recession technically doesn't happen until we've had 2 consecutive quarters of negative GDP growth. So GDP is gross domestic product, and it's basically a combination of spending and investment in the economy. Each country has its own GDP, and if the United States goes 2 quarters, that is basically each quarter is 3 months. If the United States basically goes 6 months with negative GDP growth, where it's not growing, the spending and investments are not growing, and it's actually deflating and going down, then that means we're technically in a recession. And that's the same kind of like generic overall meaning for a recession in any country. So as I make this video, we did have a bear market. The stock market did go down more than 30% at one point, but it is definitely too early to tell if we've had negative GDP growth for 6 months, because it hasn't been 6 months. 6 months has not passed in 2020 yet, as I make this video, since the first market started declining. And that just brings me to some tips on how you can avoid panic selling in the first place. Because as I said, our psychology, how we think about the stock market is going to have a big effect on how we treat our investments. And the very first tip that I want to share with you is that you should just not look at the stock market all that often, right? So the more that you're staring at that chart, the more that your mind and your psychology is going to play tricks on you, the more it's going to get you to probably sell at the wrong time and probably buy at the wrong time or whatever. And that's why dollar cost averaging, or just consistently investing in the market, is usually one of the best strategies for individual investors. As we make our money and as we have the money left over to invest, that is the money that we should invest, no matter what the stock market is. And we shouldn't really pay attention to the nuances of the individual day-to-day fluctuations, or even the weekly fluctuations or monthly fluctuations, if we are in this for the long run. Because over the long run, many years, we will most likely come out on top, and that's really what, if we look back at the history, that is what it has indicated. Of course, history is no indication of what's going to happen in the future, but it is the best thing that we have to really go off of now. And if we look at the general trend line, of the U.S. overall stock market, it's pretty much going up. It's pretty much always going up over the long run. And hopefully what we can do is we can take advantage of that by just consistently investing in the market, whether it's up or down. But the more times that you follow the market, the more times that you look at the market every day, the more likely of a chance you are to panic sell when something bad happens. And as you'll see very soon, if I were to do that recently with my own portfolio, I would be out many, many thousands of dollars. It would have been a very big mistake. And I don't want that to happen to anyone, especially you if you're watching this video, because you found a really good resource. Moving on to number 2, it kind of relates to just not looking at the stock market, and that is just staying away from the news. Because unfortunately, everything on the news, what's going to get people to view, what's going to get more viewers, what's going to be people to watch the news more often. It's almost always going to be negative news. It's always going to be something that's over sensationalized. And if you're paying attention to the news, you're going to see all the bad that's going on in the world, and you're pretty much not going to know about any of the good that's going on. Because honestly, 99% of the time, it's good going on around in the world. And 1% of the time it is the bad, and the bad is what's going to get more views. It's what's going to sell more time on air or whatever. It's going to make more money. So sensationalized bad news is usually always going to make money, and that can affect you and your investments, because bad news, especially when it comes to the general overall economies or even the world markets, it's going to tend to lead people to panic sell. It's going to tend to lead people to just make bad investment decisions based on how they feel about a certain situation. Whereas, if you were to ignore all that noise and just continually keep investing over the long run, if you look back, you're probably going to come out on top well ahead of anyone else. So be careful in how often you watch the news and how much you keep up with current events. And tip number 3 on how not to panic sell is also very important, and that is actually when the market is down. Because if it's really significantly down, you're probably going to know about it. Even if you go out of your way not to look at the stock market every day, or go out of your way not to look at the news every day, you're still probably going to hear about it if something crazy is happening in the stock market. If there's a bear market and the market is down 30% from its peak, odds are you're probably going to hear about it from someone at some point. So, and you're probably going to get curious and you're probably going to go look at it. So when that does happen, you have to look at the upside rather than the downside. Everyone is looking at it as in, oh my God, I just lost 30% of my money. Oh my God, I'm worth 30% less now. I need to get out of there because I think it's going to keep going down or something like that. So you need to, first off, continue to ignore that noise, but also look at it as an upside. Like look at it as an opportunity. Because when the stock market is down at 30%, and you're still putting money in the stock market, if you're still fine, you still have an income, you're still working, and you're still accumulating, you're still putting money into the stock market, that's a really good thing for you. When 30% off, that's a 30% off sale when the stock market is down from the peak. Because if you're continually investing, if you were investing when the market was at the top, and you continue investing when the market is down at the bottom, say like 30% down from the peak, well, you're getting a 30% discount on that item. You're getting a 30% discount on shares. So the same amount of money that you put in is going to get you more shares that are going to then increase hopefully a lot more further, like hopefully increase a lot more in the future. If you're paying $1,000 up here and you're paying $1,000 down here, well, you're getting 30% more shares at that discount. So try to look at it as an opportunity, especially if you're fine in your work, you're still working, you're still having income, and you're still accumulating wealth. Then look at it as an opportunity in order to get more shares for the same price. And there is so much more to talk about in this video, but really quick, I would really appreciate it if you can give me a like. It really helps me out. Give me that thumbs up on YouTube, helps me out and motivates me to keep making these videos. And consider subscribing to this channel, because every single week I am putting out information on personal finance, and I know that there is something that I can help you with. So please consider subscribing. But next I want to talk about kind of a small case study when it actually comes to my own portfolio. So this is Casual Sundays, and I do want to talk a little bit more about my own personal experiences. Right around February 2020, the market was pretty much at its high. Like generally speaking, it was at the tip somewhere in February, about mid-February. And my investment portfolio was worth a little over $400,000. So I think about $420,000 at its peak when I, occasionally look at it. So with my investments being at $420,000 in February, I was on top of the world. I was happy. I was the most I've ever been. It's, the richest I've ever been. It's the highest my net worth has ever been. However, one short month later, in March, the market, we took that downturn. It became a bear market, and it went pretty much as low as it possibly went. And that was somewhere around mid to late March. And in that time, it was actually March 23rd, 2020, when I checked my own investments. they were around 310K, and that was pretty much the lowest that mine has been in this certain time frame in 2020. And so you can see I lost, I lost, I should say. I didn't actually lose any money, but over that short month, my net worth temporarily declined over $100,000. And if you think of that in terms of someone without a long-term mindset, you might be tempted to panic sell because you might think that the world was ending at that time, and the investments are just going to continue going down and you're pretty much going to lose everything. But as we know now, that is certainly not the case, and which I'm going to talk about in a moment. My investments have actually recovered very, very nicely. So at the low, I temporarily lost in value about $100,000. Then less than 3 months later, in June 12th of 2020, which is a little more current in the times, I took another look at my investments and how much they were worth, and they were around $416,000. Now keep in mind, during that whole time, I was still contributing to my investments. So I did put a few actual couple $1,000s into my investments to try to make them grow, but I am back around my top, back around my peak, even though I did put in extra investments. So even though the market currently, at least as I make this video, is not around the peak it was in February, it has mostly recovered. So as you can see, my current investments are up in the low 400s right now. And when the stock market does get back to its peak to where it was in February, I don't know when that's going to be, but when it does, those shares that I bought during that time when the market was down, significantly, those shares are going to be worth a lot more. They're going to shoot up in price a lot more because I got them on a discount and I got more shares for the same amount of dollars. If I put $4,000 in during February, I'm getting a certain amount of shares, but 1 month later in March, when the stock market dropped 30% and I put in $4,000 during that month, well, I'm getting 30% more shares. And to me, who's someone who's in the accumulation phase, which basically means I'm still building my wealth, that is really good news. And that should be really good news for you as well. So this is just a little tiny case study that you can look at. You can see my net worth went from 400 and something to 300 and something, and then back up to 400 and something. And that is all in the span of a few months. But if that were to happen to me and I would have panic sold and sold some of my investments, if I was fearful about the future, well, I wouldn't have made all that money back. Realistically, my value wouldn't have come back because I would have locked in those losses down at the bottom. And unfortunately, that is what a lot of people do. And I really hope that you are not one of those people. And if you want to continue your education on personal finance and on gaining wealth and becoming financially independent, which is what I want to do, then I highly recommend, if you haven't already, that you watch this video right here. I put a lot of work into making that video, and it is a blueprint on how to build your wealth and do it very quickly. So please like this video if you enjoyed it, and watch that video if you haven't already, because there's lots of good information in there for you. Thank you so much for watching. I'm Zach from OnCashflow.com, and I hope to see you next time.